G'day folks, welcome back to another update for gold and silver. Now there's still bullish, but just watch for that bearish retrace with those divergence still in play. We're going to include some back testing on both to show you the profitability if you were trading according to the strategy. And don't forget to hit that like and subscribe button to support the channel. In terms of the outlook as of today, March 28, gold price surge. Gold prices reached a record high of $3,077 per ounce, closing at $30.73, up 0.6% on Friday. Driving factors, the surge was driven by market concerns over US President Trump's new 25% import tariffs on autos and auto parts, fueling fears of a global trade war and increased safe haven demand. Analysts maintain a bullish outlook, citing ongoing US policy uncertainty, geopolitical tensions and central bank purchases. For silver price movement, silver prices have shown mixed results with recent declines attributed to profit taking and a stronger US dollar. Supply concerns, experts predict a significant silver shortage in 2025 with a deficit of around 149 million ounces due to increased industrial demand and limited supply. And potential upside, despite current underperformance, silver remains undervalued relative to gold, with a gold to silver ratio at an elevated 91:1, suggesting potential for future price increases. So first looking at silver, we look at the long-term trends first. So you can see here on the monthly chart, the price is still above the moving averages, and so is the CCI 150 above its respective moving averages. There's no divergence to talk of, and it's currently trading along this diagonal trend line shown there. Now if you go back in history, back to this period back there, very long-term monthly bearish divergence versus higher highs in the price, so that actually pulled back and hit our, or retraced back according to that bearish divergence. And if we were to draw a retrace on that, showing you a Fibonacci, that bring it back to that significant low. You can see there it fell well below the 61% level, and it then started trading along this trend line which we drew a couple of months ago. So that's where we are at the moment, and it's currently trading around the 38% level of that Fibonacci range. That's the monthly. The weekly has got another bearish divergence that's also executed and hit that range, 23-38% level. So lower highs on the CCI versus higher highs on the price in that Fibonacci range. It's hit that range to the 38% level and it's bounced out of there. It's now approaching almost a double top to that previous high. But notice the CCI is still dropping, even though it's still somewhat bullish on both the price and the CCI, showing some bullish momentum at the moment. On the daily chart, again, we had this minor resistance up here at 34.24. It's actually broken through that, but notice on the daily as well, we've got slightly lower highs on the CCI versus higher highs in the price. We may possibly see a retrace from here. A bit too early to call yet. I want to see the price fall towards these moving averages to be more confident of the retrace happening, in which case that would have hit, if I drew a target range between that high and that low, you'd expect it to hit that 23-38% level in that range there. So we expect it to come back to there if it starts retracing. Of course, it could go higher, and if that CCI breaks a lot higher than that previous high, then we're going to invalidate the divergence. So that's the daily. If we go to the intraday chart, you can see here we've got on the 1 hour, we had a bearish divergence as well. That broke down, hit our target range. Again, that broke down to about the 50-61% level, and it's bounced out of there. And currently we don't have any other divergence, but notice it's actually pulling back a bit below that moving average of the CCI, and that price has also come back towards that moving average. So we might see possibly a retrace further to the downside to support this bearish divergence on the daily. So what we have here on the daily price, that daily chart, you can see there that price broke above the moving average around the 5th of March. And that was near that point there on the CCI as well, near the breakout there. So we've started the back test here for the stop loss approach and also for the average down approach at that point there on the 5th of March. So if you're trading that on the stop loss approach, you would have closed out the trade based on the daily hitting that, breaking below that CCI level around the 20th of March, which indicated by these crosses on the stop loss approach and the average down approach. So the average down approach, you can see there, it actually averaged down a few times, whereas the stop loss approach entered and closed a few trades. The stop loss approach at that point, if you closed it out based on the daily, it generated 2,690, and the average down approach, had you closed it out there, would have generated 17,665. Now that's trading the silver 500 or 5,000 ounce spot silver price. Now you would have not taken any trades after that, because notice the price is still above the moving average. Even though the CCI broke to the downside, you want to make sure that both the price and the CCI are either bullish or bearish. In this case, they were not aligned, and you would have started taking the next long position, and have indicated by this tick there. So that would have started there, and you'd be up today based on the stop loss approach, and still up today based on the average down approach. So nice little return so far for those long trades on silver if you're trading the hourly. So now let's look at the gold trend on the monthly. Still very strong bullish move on the price chart. There's no CCI for it, so I unfortunately can't give you any divergence prospects there. But again, very strong move on the monthly chart. On daily, however, we do have a bearish divergence. You can see there that's still going versus higher highs in the price. It paused there for a short period during this little peak. That's what I mean by saying I want to see a more effective retrace to be actually to see it happen in terms of a target. But this one had a bit of a bounce off that moving average, then it kept rising, but the CCI kept falling. So again, this is still in play. It's a bit too early to draw a retrace yet, but if it did, let's assuming it started falling from there, we'd pull it back to that level there for a Fibonacci retrace. So still a bullish move on the weekly, obviously, but bearish momentum on the CCI, so just be cautious of that. And on the daily, we had this resistance previously at 30.57. Now it's broken through that. I'm going to remove that, and there's currently no resistance showing up at the moment on the daily. But here you can see we've got the CCI still dropping on the daily as well. So I'm going to extend that to the current point there. I'm also going to extend that trend line to that new high there. So that's where we are. Now that on the daily, we did have a bearish divergence back here, and that actually hit the target range there. But again, we've got another bearish divergence currently in play, and a bit too early to call it yet. So, but still, the price looks to still be rising. Now, if we go to the intraday chart, again, you'll notice here we've got a break to the downside on the CCI, so bearish momentum on the CCI. But notice what it's done on the 1 hour chart. We had a bearish divergence here versus the CCI, and that actually pulled back. So again, if we're to draw a Fibonacci retrace on that, you can see there it pulled back quite convincingly, and that broke down just below the 23 to a 31% level, so between a 23 and a 38% Fibonacci's. So I don't trade these divergences. I use them as a potential area to avoid going long. So if you're looking at this and trading according to the daily, I'll show you the back test in a minute, but that just gives you an early warning to avoid going too strong in a long direction. Even though the price has still made new highs, again, just look at the daily, it's still bearish, possibly going to break to the upside in the next few hours, possibly, or day or two. But again, we'll play that card once it happens. So again, with the back test, what we've got here, we start the back test with the long positioning on that when the CCI breaks above the moving average, and so is the price. That's where you can start taking long positions, and that's indicated by this back test starting there, and that was at the 13th or the 12th of March. So on the stop loss approach, you would have stopped and closed out the positions at that point there, and that's indicated when the daily hits that on the 21st of March. It's indicated by these crosses. So on the stop loss approach, that would have generated about $371, and on the average down, that would have generated $826. Now you will notice the average down approach did quite nicely after that. See that, but what the price did, it actually broke down, averaged down a few more trades, and it actually ended up with 2,300. I've got to warn you though, just be careful, because that can be a bit deceiving. You don't know if that's going to retrace like it did then, or if that was going to be a start of a downturn. So to play your card safe, always exit at the right level with the daily when it hits that moving average of the CCI. So don't cry about it, let it go, and wait for the next opportunity. And the next opportunity may come when the CCI breaks above those moving averages. The price is already above. So here are the back testing or trading parameters. So if you're trading on the 1 hour time frame, you invest per trade 1 contract, the first contract entered, and you average down limit of 15 contracts. So basically the contract entries, the first one is 1 contract, next lot is 3. You got a total of 3 contracts now running. Add another 4, you got a contract, 7 contracts running. Add another 8, and then you got a final of 15 contracts maxed. And every time you average down, you make sure it drops by at least 0.005% for a 1 hour trade or contract parameter. If you're trading on the daily, the average down is 5% decline. Now, trading shares is very similar. Invest per trade $1,000 per trade. So you invest first $1,000. next slide is $3,000, next is $7,000, and finally you got the max of $15,000. And again, average down by 5% if you're trading on the daily time frame, and take profit of 3%. If you want to follow the traditional stop loss strategy for trading CFDs on the 1 hour time frame, you invest one contract per trade, take profit of 0.003% or 3% for a daily trade if you're trading on the daily time frame, and a stop loss is when the CCI 150 turns into the moving averages. Likewise, if you're trading shares, if you're trading on the daily time frame, invest per trade $1,000, take profit is 3%, and again, stop loss when the CCI 150 turns into the moving averages. Obviously, you can invest more than $1,000 in any of these trades, but you've got to be very careful of the your money management and your account balance. And I've limited it to 3% take profit on the daily and 0.003, the equivalent for the 1 hour time frame, because I found if you make it too high, in other words, if you aim for a 5 or a 10% gain, often you're a lot longer in the trade than you really expected, and it just gives you a lot more turnover when you're the smaller take profit return.
To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.